Wednesday, January 13th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at the Federal Reserve and whether it can keep control of yields, whether it can keep yields from rising too far. And why would they want to control yields? Why don't they just let the market determine where yields are going? Well, because they've got a small problem of insurmountable debt, exponential debt, not only for the government, but also corporate personal debt. And if interest rates start rising too quickly, that's longer term interest rates. Of course, short term rates, the Fed funds target, they can keep that at zero through their policy decisions. But longer term yields are more difficult. So we're going to look at what they can do. Of course, there is QE. There is Twist, Operation Twist. There's forward guidance. But today I'm going to focus on something called yield curve control, which is slightly different than QE. And yes, I personally think the Federal Reserve is between a rock and a hard place in terms of the yield curve and controlling interest rates. It could be a big problem for them. I think at the end of the day, they're just going to do more and more QE, which is just buying all the treasuries to keep yields down, because when you buy a bond, you drive the price higher and you drive the yields lower. Prices and yields in bonds are inversely related. That will, of course, make the balance sheet a lot bigger. And I think the Federal Reserve doesn't like that too much, but they probably will have no choice. We're going to look also, after I talk about yield curve control, at the CRB index, which measures the value of the overall commodity market. CRB index is the Commodities Research Bureau index. It's been around since 1957. So I've seen an article on Zero Hedge about yield curve control. It's very basic. I don't think it's the best article really, but he does mention one thing towards the end of the article, and I'll put this article actually in the description so you can read it. He says a lot of things I don't agree with about gold and what's happened to yields in the last week or so. But be as it may, one thing he says that is quite interesting is this. In the 1940s, real yields in the US got to negative 10% plus for several years to deflate the debt stock. The math is especially worse now for the US today in terms of debt and entitlements. Every month I look at the Treasury monthly statement and more money is being paid out in mandatory, i.e. can't cut it. Spending then is being taken in taxes and revenues, which would be game over. Unlike the 40s and 50s, we have no real growth drivers due to demographics and financialization of the economy until we find a replacement for oil. So there's no option but to keep real yields as negative as possible to try to inflate out. Basically, the Fed/Treasury must solve for X each month, which is the amount we need to print. So basically, he's saying that, yes, it worked well in the 40s. Real yields were negative and it inflated the debt away. And he's right about that. Nowadays, it's going to be a lot harder because the government is so much bigger than in the 40s after the war, of course. But I'm going to refer to, and I'm going to put another article, a link to it in the description of this video. And it's from Brookings Institution. What is yield curve control? So I've gone through this article. And I recommend that you read it if you want. It's not very long, and it's a good article, actually, because it talks about the pros and cons of yield curve control. It looks at what Japan has done in terms of yield curve control, and it also looks at the fact of credibility for the central bank in terms of yield curve control. So what's the difference between yield curve control and, let's say, QE? Well, QE is when the central bank says they're going to buy 120 billion, like they're doing now, the Fed, every month, of Treasury securities and mortgage-backed securities. And the hope with that is to keep yields low. But yield curve control is when they have a target. They tell the market, we will not let the 10-year yield go above 1.25%. Does that mean that they're going to be doing QE to keep it there? No, they try to convince the market that if someone decides to sell a 10-year with a higher yield than 125, the Fed will step in and actually buy that bond to keep the yield at 125. So it's not QE, but the thing about yield curve control is if the market loses or perception of inflation or rising prices increases, the market might not believe the Fed will defend that 1.25% level, and they might start selling, and that will push the Federal Reserve to actually start QE again, actually to print a lot of money to keep that yield there. And they might lose credibility, but at the same time, I think the Fed does want high inflation or rising prices and low yields in order to inflate the debt away. So I think they wouldn't have a problem with that. In Japan, it's worked quite well. Prior to the instituting of yield curve control in 2016, they were doing a lot of QE, and actually the pace of QE has slowed down. But Japan is different because the savers in Japan, there's a lot of savers. The JGB market, Japanese government bond market, it is a big market, but they don't trade as much as in the U.S. Treasury market. So the Bank of Japan has been successful in instituting that. So what's the advantage of having yield curve control and keeping yields at a certain level? Well, first of all, in a country that has a lot of debt like Japan and the U.S. now, it helps keeps yields low, and it pushes other securities like corporate bonds and junk bonds. It pushes their yields lower, mortgage bonds. So it increases spending. It keeps spending going. That's the whole idea. So the credibility of the Federal Reserve. Yeah, the credibility is that the people in the bond market don't trust the Fed anymore because they see prices actually rising, inflation expectations rising, and they're telling themselves, why are we accepting 1.25% in the Treasury if the CPI is at 3%? But they might. You never know. You never know with the bond market and investors. And if they don't, I think we're going to have a combination not only of yield curve control, but QE at the same time. And this article in the Brookings Institution website talks about that as well, that it could be all a mix of this. What about Operation Twist? Well, Operation Twist is when the Fed has stopped QE and then it decides to sell short-term paper that it has on its balance sheet for longer-term paper in order to keep longer-term yields from rising too far. That's Operation Twist. I guess you could also favor the longer end of the yield curve when you're doing QE instead of buying more short-term paper, you buy the long-term paper. So it's all a mix, twist, QE, yield curve control, basically manipulating yields or interest rates in order to keep the whole thing from imploding. It's going to be very interesting. I saw an interview, I think a couple of days ago or so, I'm not sure when, Jeff Gundlach, who really is a bond king. He manages a lot of money. I forgot, is it Value Line Fund? And he said he expects the CPI, the measure of prices, to reach almost 3% by May or June this year. So with yields around 1% in the 10-year, that means a negative 2% real rate. And I actually think the Fed might actually be looking to go back to the 40s and early 50s, where they had really high negative real yields. So yes, yield curve control is something in their toolbox. This article from Brookings talks about how it says here, prior to the COVID crisis, current Fed governors Richard Clarida and Lael Brainard, as well as former Fed chairs Ben Bernanke and Janet Yellen, said the Fed ought to consider adopting yield curve control when short-term rates fall to zero. So here they were talking more about yield curve control at the shorter end, because at the longer end it's a bit more difficult. They might need to eventually buy a lot more of these longer term notes in order to keep yields under control. But it's interesting that Janet Yellen is for yield curve control, and she was, of course, the chairwoman of the Federal Reserve until a few years ago, under President Obama and a little bit under President Trump. She's now going to be, she's the nominee for the post of Secretary of the Treasury. So yeah, the Fed and the Treasury will have to work together. So it will become one. So that's yield curve control. I think the more they talk about these tools, yield curve control, forward guidance. What's forward guidance? Well, it's just telling the market what the Fed thinks, that like right now they're saying that rates are going to stay at zero, short-term rates, until 2024. That's guiding the market forward. Twist, QE. All that means is that they're going to keep inflating the system. The reason they say that there's a danger of deflation is because they have to keep inflating. So back in the 40s and 50s, the price of gold was fixed at 35, and Americans couldn't buy monetary gold. But now you can. So I think that's the escape valve for investors to protect the integrity of their savings. Why integrity? Well, because you're going to be losing a few percentage points in real terms over the years. That's the only way they can write off the debt, through inflating it away. The other option, of course, is to default on the debt, and I'm sure they don't want to do that because, as Alan Greenspan once said, the United States has a printing press. It can just print the money and pay off the debt. So that's what it's all about. So with that, let's look at where the markets are. Before I do that, I'll show you how the CRB index is climbing really a wall of worry. I think it looks very bullish. You can see here that it's continuing to go higher here. We made a new recent high for this, for the last 12 months or so. And if you look at the monthly chart, look at how much room on the upside it still has, the CRB index. And that's why commodities look relatively cheap, I would say, versus everything else. So it's 9:20 a.m. We're a little later today. Yes, gold, just before I started this video, was at 18.57. Now it's dropping. It's down $3.50. The manipulation continues. It's not going to last forever. They can't do it forever, or else they run out of gold. But yeah, we are at 18.51 right now. The range has been 18.49 to 18.63. So yeah, London is the center, with New York, center of gold market manipulation. In New York, of course, you've got COMEX. COMEX really runs 24 hours a day. The LBMA is more limited, and it doesn't run 24 hours, but the banks really trade. Or LBMA, I would say, is an over-the-counter. And then in Europe as well, when Europe comes in, like now, you got people like the Bank for International Settlements who have accounts with COMEX. They're in it, in this market as well, manipulating the price of gold. They're manipulating silver today as well. Silver is down after doing really well yesterday, and overnight we got up to 25.70. Right now we're down 18 cents at 25.35. So yeah, they're trying really hard to keep people from looking at the barometer of inflation, which is rising gold and silver prices. And it's frustrating, but you need to be patient. I would say that's the most important thing you need to remember. The stock market, the Dow futures up 60 at 31,126. S&P is also up about 0.2%. S&P futures. NASDAQ futures is up 1/3%. The fiat currencies, yes, sterling did well yesterday. I think Andrew Bailey, the governor, said that they're not thinking about negative interest rates. The day before, one of the members of the MPC said that negative rates would be good. So sterling rose because of that. I'm not concerned. All these fiat currencies, as we know, are going to continue to sink versus real money. Right now, sterling is up slightly at 136.86. The euro is down about 0.15% at 121.87. And the dollar is basically unchanged versus the yen at 103.87. Dollar is up about 1/4% versus the yuan at 645.70. The commodities, as I said, climbing a wall of worry. Very few people are looking at commodities, even though some people are starting to look at it, like Goldman Sachs and Wall Street. But I think the public is still focused on the stock market, on tech, and I think it's a big mistake. Right now, we've got copper up 1/4%. We've got WTI crude going towards like 54 now. We're at 53.45, up 0.5%. And the other thing I noticed in the last 24 hours or so is that the 10-year yield is dropped a little bit. I think yesterday we got almost up to 120, very close to 120. And right now we're down about 2 basis points at 112. So yeah, I think the market is being cautious about being too bearish about bonds, because the Federal Reserve can always change the mood in the market. They're meeting on the 26th, 27th of this month. I think the market might be waiting to see if they say something about all their policy toolkits or yield curve control. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And just before I go, I've been posting a little more in my blog. It's called Moneco64.net. Some of my ideas there, some articles that I like. That's like a replacement for Twitter. So if you're interested, go to that website or blog, Moneco64.net. So with that, I'd like to wish you a great rest of the day. Take care and goodbye.